QuickBooks Online 2021, opening balances and add accounts to chart of accounts. Let's get into it with Intuit, QuickBooks Online 2021. Here we are in our Get Great Guitars practice file. We're going to be continuing to enter our beginning balances and add any necessary accounts to do so. If we go back on over to our trial balance, we've been entering those balances that have kind of like special needs as we enter the beginning balances. Now we're going to go back to those balances that should be a little bit more straightforward to enter. We'll start off here with the checking account. Now, a few things to note with the checking account. One, we will have possibly outstanding checks and deposits that may become a problem when we do the bank reconciliation, but we'll talk about that when we get to the bank reconciliation section. And two, then it might ask you about bank feeds and setting up a link to the bank feeds. When you're setting up the bank feeds, we'll talk more about them in the future after the whole practice problem. Once you have a good understanding of the accounting system, then go ahead and you could set up the bank feeds if you would like to and make sure you know how it fits into your accounting system. But the idea is that we want to make sure we pull over the information from the bank feeds that are relevant, and we have to think about when our cutoff date is going to be basically in order to do so. So we want our starting point to be that 25,000 and then enter more data related to obviously checking after that point. Okay, so let's go back on over. I'm going to do this by going to our chart of accounts on the left-hand side this time, bottom left-hand side. Here is our chart of accounts. We're going to be adding then a new account. I'm going to go up top to do so. Say new account up top, green button. And then the first account is going to be a checking account. So I'm going to say bank account. It's got then the detail. This detail account doesn't do a whole lot. I'm not sure even exactly what it does do, but it gives you this detail account. So we'll pick the appropriate one, which will be our checking account. Now, in practice, you might have multiple checking accounts, so you might want to name it more specifically. You might want the bank name. And you might even want, for internal use, the number, like the last 4 digits of the bank number or something like that, so you can distinguish it from any other checking account that you have. Then when you run reports, we could do various things in order to make the reports be more professional and not show things like that on the actual reports that we're going to give to others by basically making sub-accounts and things like that. So we might talk about that more in the future, but for internal use, as you jump back and forth to the balance sheet and your data input, if you have multiple checking accounts, you may want to indicate that. The easiest way to do so is by putting basically the last 4 digits of the account number typically. So then we have the sub account. No, I'm just going to save that. And there it is. There's our checking account. Now it didn't ask us for the beginning balance. It's currently at 0. So what I'm going to do, the easiest thing to do, I believe, is to go into the register. I'm just going to go right into the register. And this looks similar to a checkbook, but you have a register for, pretty much all of the balance sheet accounts. I'm going to close the hamburger up top, and then I'm going to add an item to it. It's basically going to be a deposit type of item that we're having because it's going to be an increase here. And I'm going to make sure I do it in the prior period, let's make it 12/31/20. And then I'm not going to put a payee because it's a beginning balance. We might put beginning balance here, and it's going to be a deposit, and the deposit amount we said was for, according to here, 25,000. 25,000. Now, obviously, we are not actually making it a deposit at this point in time. This is the beginning balance that we are now putting into place. And then the other side, I want to put it to some type of equity account here. So I'm going to look for the equity type of accounts. So equity, opening balance is where they typically are putting it. The owner's investment and the owner's personal, or the retained earnings account. I'm going to go ahead and put it into opening balance right now to keep kind of consistent with their items. That's kind of a make-up account. It's a made-up account. But at the end of this, I'm going to go into opening all the equity, and we will reassign them to the proper equity accounts. We'll talk about that in a future presentation. I'm going to go ahead and say save it. And there we have that. So now we've got the 250, which is way too high. That's not what it's supposed to be. Let's take a 0 out of that. 0 out of that. It's 25,000. That's what it's supposed to be. Then we'll update it. There we go. Let's open up the financial statements, see the impact there as we go. I'm going to duplicate the tab to do so. Right-clicking on the tab, duplicating the tab. And then we're going to open up our balance sheet. Going down to the reports on the left-hand side. We're going to then go into our favorite report, that being the balance sheet report. So balance sheet report then opening up. And let's go up top and range change it from 01/01/20 to 12/31/20. Run that report. We then have the checking account right there at the $25,000. That's what we just added. There's the deposit. If I go into the deposit, it's going to take us to a deposit form, not to the check register. There it is, other side going to opening balance. So we're going to get used to those forms as we go through, even when we use different methods for data input. And then down below in the opening balance, the other side went down here into the opening balance equity. All right, let's go back on over to the register, the first tab, and let's open up then our accounts again. I want to go back to the chart of accounts. I could do it this way too, probably better, by going back to the chart of accounts, use the back thing. And let's look at the next account we need. So we got the checking. We already did the accounts receivable. We did the inventory. These two are kind of in reverse order, so we would probably think first furniture and fixture and then accumulated depreciation. So let's consider those two accounts. Did they give us a fixed asset account? I'm going to check. I'm going to scroll down and say it would be a fixed asset type account, which would be right after the current assets and then before the payables. We don't have one. So I'm going to make one up. It's going to be a furniture and fixture type of account. Let's go up top, say new account. New account. It's going to be property, plant, and equipment, furniture and fixture, which they call fixed assets. Fixed assets here, PP&E, furniture and fixture, fixed asset. And this one, it's not accumulated depreciation. It's going to be building. We're going to call it fixture. No, fixture. So they got fixture, asset, furniture. So they kind of got it in the reverse order. I like to call it, or we have it named, furniture and fixture. I think that just sounds better, doesn't it? Furniture and fixture. But we called it furniture and equipment. That's what we called it. All right. Furniture and equipment. Equipment. Furniture and equipment. So I'm not saying what would be the best way to break these items out. You probably want to match these when you're putting these in place to what you would see on your depreciation schedule that's coming from your taxes, from your tax software oftentimes, so that you can make this thing line up as easily as possible. That would be my general rule for putting in the depreciable assets. Line it up to the categories that will typically be on the tax depreciation schedules so that you can get help from your CPA firm to kind of calculate hopefully the accumulated depreciation. But we'll keep this in accordance with what we have in our beginning balances. And then we have the original cost. I'm going to put this down here at the 75,000. 75,000 as of date 12/31/20. Now, also note that we're not going to be tracking this furniture and a fixture item by item, meaning I don't know what the actual line item of furniture and fixture is. I'm just putting the total in there, which could be comprising of many different things that would be on the depreciation schedule. We are then imagining the depreciation schedule is somewhere outside of QuickBooks, which is typically the case for QuickBooks Online, oftentimes it being in the tax software, because the tax software is going to have to calculate the tax depreciation anyways, and typically we'll have the functionality to calculate different schedules if we need to. And that's where we're going to imagine we have the detail then of breaking out the actual individual items and the depreciation related to them. In that system then, you would need help from the accounting firm. We need to talk to the tax preparation firm anytime we sell equipment and make sure that we provide each purchased equipment to the accounting firm as well so that they can record it on the depreciation schedule for taxes, and if we want a different schedule for book purposes, to provide us that as well. So I'm going to say save and close. So there we have that. So notice in our lineup, it's organized by type, and that's going to be down here, furniture and fixture. Let's do another one for the accumulated depreciation, which is kind of linked to it. We have that beginning balance here, and then we'll check out where it put these items, which once again would probably go to an asset, the other side to beginning balance for the owner's equity. So let's go back up at top again. I'm going to do another one for the accumulated depreciation. That's going to be this one. That's the decrease in value, allocating the cost of the furniture and fixture, the property, plant, and equipment, the fixed asset over the useful life. So this is what has been allocated thus far for it. So we're going to go to the fixed asset. This is going to be the accumulated depreciation. And if I go back on over here, it's just called accumulated depreciation. So notice this is another one that's a little bit tricky. We might go into it a little bit more detail later, because you might want a different accumulated depreciation for every type of property, plants, and equipment account. For example, automobiles versus building versus land won't be depreciated, but building, land, equipment, so on and so forth. You might want another accumulated depreciation account tied to each of them, or you can have one accumulated depreciation account, which basically is going to be all of them together. We only have one item at this point in time for that's going to be depreciated, so we really only need one account at this time. We might go into that issue in a little bit more detail. It's up to you in terms of how you want to format your reports. So again, we might talk about that more later. But this is going to be the description. We don't have a beginning balance down here. When do you want to start tracking your finances from this account? Beginning. Well, I'm just going to save it. I'm going to say save it and close it. And then if I scroll down, now we've got this other one, accumulated depreciation. I'm going to go to the register on it again and enter the balance in the register. So this register looks like a check register, but now it's the accumulated depreciation register. And I'm just going to add a journal entry now, a journal entry type form. We're seeing it in terms of increase and decrease rather than debits and credits. Now this one's a little bit tricky again, because if I enter this as of 12/31/120, and I say this is going to be the beginning balance, notice it says decrease, increase. Now I would think, if I'm thinking debits and credits, this would be an increase to this account. It's increasing in the credit direction. But because it's a contra asset account, I believe that it's actually going to be a decrease here. So this is why debits and credits actually kind of work better if you understand the debits and credits. But if we go the wrong way, which I think I'm going to do on purpose here, 7,500 on the increase, because I would think it would be an increase, I can then just check the account and see if it went the right way, and if it didn't, then I'll change it, because there's only two accounts affected. The other side's going to go to equity, so I'm going to go to equity down here. I'll just put it to opening balance equity. We're washing everything out into the equity section. That's our plan. Let's save it, and then let's check it out on the balance sheet. If I go to the balance sheet and I refresh it, so we're working with a fresh report, then I scroll back down. We've got these two are going the wrong way, see? So here's the furniture and equipment, 75,000. This should be a contra asset account, and it should be decreasing the balance. So the balance should be going down. So it went the wrong way. I could fix that. I could drill down on it here and say it's a journal entry type of form. Go into it here, and then we could just say there's a journal entry. So notice again, it changed the register to the default form if there is no other form, which is a journal entry. And then I'll just change the debits and credits. I'm going to say it's going to be a credit here, which I wouldn't have got wrong if it was in journal entry format the first time. And then I'll call it beginning balance here as well. So it's beginning balance, which all items in the opening balance equity should only be beginning balance transactions. So I'm going to save it and close it, or just save it and then X out of it, and then go back to the report. And now it's doing what we would think it would do, right? We got the furniture and fixture, the accumulated depreciation, furniture and fixture. If I go into it, the other side, it's a journal entry as well. It should be going to the opening balance equity. We'll check that out shortly. Going back on over. Notice also that I would like to have the furniture and fixture on top, but because it's in alphabetical order within there, the other's on top. And that we could fix that with account numbers, or you could try to sort the sorting up top, the sorting items, so that we have, they're right here, the sorting items. So we have descending order. You could do that, and that will put the largest number on top. So that could help a little bit to fix that problem. But if you have multiple categories, it could still get a little messy. The account numbers is like the preferred way to fix it, most likely. Other side's going down here into the opening balance equity, as we said, for the 75,000 here and the 7,500. So those two have been taken care of. So let's go back on over to see what else we have. 75,000 accounts payable. We already did that. A Visa card. Let's set up a Visa card, a credit card account. So we'll go back on over. We can do that one. First tab. We'll go back to the chart of accounts. See if we have any credit card accounts set up by default. I don't think we do yet. So it's going to be a liability account. Right? No. So let's set up a credit card. We're going to say new account, drop down. It's going to be a credit card type of account. Credit card, we'll keep the name, I'll call it Visa. Visa. And then it says enter to, just gonna keep it there. I'm gonna say save it and close it. And then I'll just enter into the register the beginning balance again. So we'll go back in, credit card, register, closing this. I'm gonna hit the drop down. And this one, I think it's easiest to do with a journal entry, although the most common transaction is probably an expense type of transaction. Let's do the expense type of transaction. And I'll say this is as of 01/01, let's say not 01, 12/31/20. And this is going to be the beginning balance. And the charge is going to be 1,000. And then I'm going to hit just that miscellaneous expense account that they hit before, miscellaneous expense. But it's in the prior year, so it's going to go into equity. But I'm just following their method of using basically an expense type of form that will then flow into equity, because this is in the prior year and our stuff is going to be starting in January 2021. So let's see what happens here. I'm going to save this, go back to our report for the balance sheet, refresh the balance sheet so we're working with fresh stuff, scroll back down, there it is. There's the 1,000. So there's the 1,000 there. It's an expense type form, even though we entered it into the register, which looks like this. Going to close this back out, scroll back up top. The other side went to the income statement, but for the prior year, which then rolled into net income here. It's in net income, which will roll into retained earnings. In other words, let's open the duplicate cell. Let's duplicate the tab up top. Let's open up the P&L. The profit and loss, the income statement right here, profit and loss. And if I run this for the prior year, 01/01/20 to 12/31/20, and run that report, you can see it's included in this 16,000. That includes this bill for that 1,000 we put in. But then it rolls into net income for the prior year, and then in the current year, it'll be back to zero. Everything will wash out into the equity section. It'll close out, as they say, the more proper term. 01/01/21 to 12/31/21, nothing's going to be there, because we're ready to go in the current time period with our data entry as we enter new data. Let's go back to the next one. That's going to be the credit card. Then we got a loan. We got a loan outstanding, so that should be fairly straightforward. Back to the first tab. Let's go back to our chart of accounts. We're going to enter in the loan balance, see if we have any loan stuff, a loan account. We do not, so we'll just add the account up top, no problem. Going to say this is going to be a loan. So when we make the loan, the question is it going to be like a short-term loan, or do we want to put it, is it a long-term type of loan? So, and that would be whether or not it's going to be something that's going to be due within a short period of time or within 1 year period of time or not. We also might have a current portion to the loan and a long-term portion to the loan. So what I'm going to do is I typically will put the loans into one account, and I typically put them into the current portion so that, because it's more common that you would pay it out of the current liabilities, and then I will adjust the long-term portion of the loan periodically as needed with an adjusting entry at the end of the year, if we need to report it, short-term and long-term basis being broken out in that format. Also, if you have more than one loan, then you might want to break out your loans into multiple accounts, or you could group them together. I like to put them into multiple different accounts so I can track my loans separately, but then when I report them, possibly combine them together with something like a journal entry or a sub-accounts. So we may touch in on that at future points, but right now I'm just going to put it into other current liabilities. And I'm going to say that this is going to be an other current liability. You can choose a loan or a loan payable, let's say. Loan payable, I'll keep that description. Again, that's general. That's a very general description. If I have multiple loans, I'd probably want the actual loan or loans payable and then possibly the last 4 digits of the loan number, or possibly the bank that I'm paying if they're different institutions, or possibly both. The institution I'm paying and the loan number, so that I can track it easily as possible in the system. And remember, there's 2 goals when we enter these accounts. 1, to make the data input as easy as possible, and then 2, to make the reporting to external users as easy as possible. We want to keep both those things in mind when we're constructing our chart of accounts. So one way you might do it is you might make a loan payable parent account, then sub accounts of it, so that when you report to external users, you can have one account called loan payable, and when you're using it for internal use, you then have the sub accounts that you can look into for more detail. Let's go ahead and save and close that, and then we're going to go down and say, all right, loan payable. Loan payable is going to be down here, so let's add in the register. Let's go into the register, and this one, probably the journal entry is the proper form to use. So I'm going to put this in as of 010120, and this is going to be the beginning balance, and we're going to increase. This is increasing a liability, which I would assume to be an increase, 22,000, and the other side's going to be going to the opening balance equity. We're just going to put it to that equity account again. Opening balance equity. Let's save it. Check it out. Go up to our reports on the balance sheet. Make sure it's fresh, so we're not looking at some rotten old report, but like a nice fresh one. And then we'll go down to the loans payable, 22,000. There it is. There's our journal entry. If I go into it, we see a journal entry. It's journal entry type form. Closing that back out, back to our report up top. The other side then going into the balance, or to the opening balance equity. And so it should be in there somewhere, but I'm going to change the date range to 010120. We can then see it. So 22,000, there it is. Let's go back up top. Is there anything else we need to be entering? Is that the last one? This has been kind of going on for a while. Yeah, the last one is equity. Equity's at the 77,896. So now let's just kind of double check what we got thus far. So 77,896 in total, that's good. So if we line these up then, if I try to line these up on a side-by-side kind of way, like if I put this over here and make it smaller, and I try to line these up and make like this smaller, this is taking a while. So there we have the checking account there. So the checking account, I'm gonna pull this over here just a smidgen. So there's our 25,000, there's our 20,500, there's our 2,896, there's our 75,000, there's our 7,500, and then our 15,000 here, looks good, our 1,000 there, and then our 22,000 here. And then these two are not in the proper accounts. We want to put them into the owner's equity, but the total equity is correct. Everything washed into total equity correctly. So now we're just going to do a journal entry to reallocate and getting rid of this opening balance equity. We'll do that next time. And then everything should be rolled into where we want it to go. So let's just check a trial balance too, so we can open the trial balance, because we're getting used to using the good old TB. Trial balance is what that stands for. It's not a disease, or in TB is, I think, it's a tuberculosis. It's not worse. It's good for us. It's a good thing. It's a trial balance, the TB trial balance. So there we got it. And so there's our trial balance. Let's make this as of 010120 to 1230. Well, let's make it as of 010121 123121. And so there's going to be our trial balance, which is in essence just the balance sheet now, because remember everything else closed out to it. 25,000, 20,000. See how much easier it is to look at 2,89675, 75,000, 15,000, 1,000, 22,000, and then these netting out to that 77,896, which is the net of these two. If I was to then look at the trial balance for the prior period, 010120 to 123120, we're going to have some income statement numbers down below, these two numbers. So the equity section, including the opening balance on down, which includes income statement accounts, is now broken out into detail here. But then if I roll that over into the current period that we're going to be starting to enter data on in 21, 12/31/21, and run that report, then we have everything's lining up as it should, and we have no income statement accounts, and we just need to then reallocate the opening balance equity. So remember, that's your objective when you're entering these beginning balances. It seems like you're kind of just entering stuff like, whatever, willy-nilly or what, but as you enter these beginning balances, but everything else should wash out to equity. And as long as everything washes out to equity, then it has to be right? If all these balances are correct, then the net is going to go to equity. And then that means the equity in total will be correct. And then we just need to adjust the total equity to the proper accounts in accordance with what type of entity we are, sole proprietorship, partnership, which we'd have to allocate to multiple partner accounts, or corporation, where we would have the retained earnings and capital accounts, or retained earnings and common stock possibly.